Hello everyone, it's Elliot Yu here with the Free Market Speculator, and welcome to my Sunday Deep Dive. In this weekly video, we look at a key chart, trend, or indicator that caught my eye over the past week, and I explain what it means, or at least what I think it means for financial markets. Now, since the close on May 28th, the S&P 500 is down about 3.2%, and the NASDAQ 100 is down about 3.9%. However, the S&P 500 Equal Weight Index, which is an index that weights all S&P 500 index members equally rather than by firm size, by market capitalization. So that's up almost 1.4%. And the Russell 2000 Index, which is a popular index of small cap stocks here in the US, well, that's up a little over 2.9%. So what's the problem for the broader market? Now, despite what you may have heard, it's not really technology stocks as a whole, at least not yet. The S&P 500 Technology Index is down less than 3%. So it's actually outperforming the S&P 500 since late May, since that May 28th close I've been referencing. And the Small Cap Technology Index, well, that's down less than 0.4% over the same period. So that's barely moved. The real headwind is the so-called Magnificent Seven large mega cap technology and growth stocks. Now, the Round Hill Magnificent 7 ETF, which trades under the symbol MAGS, M-A-G-S, well, it's an equally weighted fund ETF, and I believe it's rebalanced quarterly to be equal weight, and it tracks those seven Magnificent 7 stocks. So since May 28th, it's down almost 13.1%. So pretty bad sell-off there. Now, since these seven stocks comprise around 1/3 of the entire S&P 500 and more than 40% of the NASDAQ 100, it's very difficult for the broader market indices like the S&P 500, the ones that most investors watch, to make much headway with the Magnificent Seven getting hit that hard. So this week, I want to cover three main points. First, how serious is the loss of market leadership from the Magnificent Seven for the market as a whole? Second, my thoughts and some historical parallels to help us understand if this marks a top for the Magnificent Seven or the broader S&P 500, or if this is just a correction. Third, the power of momentum. Now, I'm going to break down the sort of market scans I do most days, most weeks at least, and how and why it led me to add a new stock to the model portfolio in this service just last week. The fact that the broader market is not down much while the Magnificent Seven are down 13+%, that tells you there are a lot of stocks and industry groups performing well right now, very well right now. I see a ton of opportunities and a lot of upside momentum. You just have to dig a little deeper to find it. So let's jump right in with this. The chart on your screen right now shows the Magnificent 7 ETF, again, symbol MAGS, as a blue line since inception back in 2023, inception of that ETF. Now, the red line below the main chart shows the ETF's relative strength to the S&P 500. So this is the relative strength of that MAGS ETF to the S&P 500. Now, as you can see, the Magnificent 7 stocks broke higher above their late October 2025 highs in early May in absolute terms. But that breakout actually failed miserably, and the group subsequently collapsed back below that key technical level I've marked with a black line. Again, that's the blue line. Even more important, though, look at that relative strength line. Again, that's the red line, which plummeted below the March 2026 lows to the lowest levels since the spring of 2025 on Thursday of last week, before managing a very small bounce on Friday. For much of the past 3 years, the Magnificent Seven have been the market leaders. And while there have been bouts of underperformance over this time period, as you can see on this chart, this is the longest period of underperformance since early 2023. As I'll explain in just a moment, the relative strength of the Magnificent Seven to the S&P 500 peaked on October 29th, 2025. So that's now about 8 months ago, right? More on that, as I said, in just a moment. At the same time, look at this chart. Now, this chart is from stockcharts.com. Great website, by the way. The S&P 1500, now that's an index comprised of the S&P 500, large caps, we all know, S&P 600, which is small caps, and the S&P 400, which is a often overlooked mid-cap index. So companies that are ranking somewhere in size between the large caps in the S&P 500 and the small caps in the S&P 600. So this S&P 1500, it's a broad index offering a look at the performance of a wide selection of stocks in different industry groups of all sizes, and as I said, across many different sectors and industry groups. Now this chart shows the percentage of S&P 1500 stocks trading above their 200-day simple moving averages. So their individual 200-day simple moving averages. Now, as I've talked about before here, the 200-day simple moving average, it's a good gauge of intermediate to long-term trends. And as I said, I've discussed it at length in prior issues and episodes of the Sunday Deep Dive. Maybe I'll link to those below, but they're here in the last 3 or 4 months. I've talked a lot about this index, this indicator. Now, simply put, if a stock is trading above its 200-day moving average, we can say that stock is in an uptrend, right? This chart reveals that almost 70% of stocks in the S&P 1500 are trading above their respective 200-day moving averages. Most stocks are in uptrends, and market breadth, measured on this basis, has been improving dramatically since the middle of March this year, so the last 3+ months. Generally, I like to see 60% or more of these S&P 1500 stocks above their 200-day moving averages to indicate a healthy uptrend in the market, with good breadth. And here we're at almost 70%, which, as you can see, is in the higher end of the range we've seen over the last few years covered by this chart. Now, along a similar line, okay, on Thursday last week, there were 157 stocks traded on the New York Stock Exchange. Now, I'm looking at common stocks only, no closed-end funds or ETFs or preferred stocks, none of that. Only common stocks trading on NYSE. So 157 of them made new 52-week highs on Thursday. Now, that's the highest number we've seen since late February, about 4 months ago. So while the S&P 500 is struggling to make much upside headway with the Magnificent Seven kind of weak, as I said, the Mag 7 account for a combined weight close to 1/3 of the S&P 500. Most stocks are in uptrends, and there are plenty of stocks breaking out to new highs. Let me be clear. I suspect that we have not seen the peak for the Magnificent Seven on either an absolute basis or relative to the S&P 500. There are 3 main reasons I say that. First, every quarter I listen to or read the transcripts of dozens of conference calls, and many of the companies I follow most closely, well, they're outside technology. Energy, industrials, consumer discretionary, even healthcare stocks. I am hearing a lot about artificial intelligence, AI, on those calls, and a lot more about AI compared to even just really 6 or 12 months ago, even 3 months ago, when they were reporting, fourth quarter earnings, back early this year. Real companies in these sort of old economy businesses, they're leveraging AI to cut costs and improve efficiency. That's adding up to real profits and real cash flows we can actually see in their results. So I am a believer in AI as a transformative technology. And while I'd be the first to say that it may not live up to all the most extreme hype, some crazy stuff out there, there will undoubtedly be speed bumps along the way. The Magnificent Seven are key to enabling this growth. Second, highly visible risks that everyone is already talking about, well, they're rarely what leads to a top for a sector or the broader market. In the monthly Bank of America Global Fund Manager Survey, which I reference in these videos quite frequently, respondents have been highlighting an AI stock bubble as one of the most serious, what's called tail risks, or sort of extreme, black swan events, right, for the market. The tail risk for markets has been almost every month since last autumn. They've been highlighting a potential AI stock bubble as the most, or one of the most extreme tail risks out there. Now there's also this. Now this chart shows the net non-commercial position. That's gross longs less gross shorts in the NASDAQ 100 futures contract traded here in the US. Now this is data reported as part of the Commodity Future Trading Commission's, CFTC, their weekly commitment of traders report, released Friday afternoons usually at around 3:30, 4 o'clock. The non-commercial traders, they're speculators. They're people actually looking to profit from rises or fall in the price of the Nasdaq 100 rather than trying to hedge their risks. The blue line here is the net position in contracts, the total net contracts, net long being a positive number, net shorts being a negative number. The orange line on the right-hand scale, that's the Z-score, and that's based on the past 104 weeks. That's 2 years of data. Now that thick black line, that applies to the Z-score line, and that marks a Z-score of 0 on the chart, neutral. Now, full disclosure, I don't find the CFTC commitment of traders data on stock market indices as useful as I do the same data on bonds or physical commodities like crude oil, corn, and metals. In fact, just a few weeks ago, I recorded a deep dive video talking about the extreme short position we were seeing in long end treasuries, being a contrarian bullish sign for the long end of the bond market, and that's certainly played out here since the middle of May. However, non-commercials are the most net short NASDAQ. So even though I don't look at it quite as closely as I do for these other markets, we are seeing an extreme reading here. Non-commercials are the most net short the NASDAQ. They've been since early 2023, okay? And the Z-score is sitting at negative 2.19 standard deviations. Now that's a big shift from the positive 2.6 standard deviations, the extreme long reading we saw in, guess when, right? Mid and late October of 2025, last year. As always, I use the speculative position as a contrary indicator. And that very bullish speculative position in the Nasdaq 100 last October certainly worked, right? As that was a key top for the Nasdaq 100 and the Magnificent Seven relative to the broader market. Again, as I talked about a little bit, and I'll get into a little more detail here in just a minute. Now, we're looking at the flip side of that situation we saw in October 2025. At a minimum, it would be unusual, very unusual, for the Nasdaq 100 to completely fall apart with the speculators all already so bearish. It's just not how it usually works. Third, just because a stock or a group of stocks is up a lot doesn't mean it's a bubble. Moreover, even if it is a bubble, that doesn't mean it'll pop this week or this month or in 2026. As John Maynard Keynes, the famous British economist, once quipped, markets can be irrational longer than you can remain solvent. Just consider, most of the Magnificent Seven stocks are currently trading at a price to earnings ratio in the 25 times range. Now on a forward PE basis, the only outlier is Tesla. The median forward PE for the Magnificent Seven, the median, it's around 23.5 times, and the average, excluding Tesla, is 23.6 times. So they're hardly cheap, but these valuations are a far cry from Cisco Systems trading at 100 times forward earnings back in 2000, or Qualcomm at 160 times earnings in March of 2000. And speaking of Cisco Systems and that late 90s and year 2000, NASDAQ boom period, this chart shows the price of Cisco Systems from early 1996 through the end of 2000 as a blue line. The red line shows Cisco's relative strength to the S&P 500 over the same period. Very similar to the chart I showed of the Mag 7 for the current period, but this is back in the late 90s, early 2000s. Cisco Systems was one of the clear leaders of the late 90s tech boom and the NASDAQ bubble of that era. The stock actually peaked in March of 2000 and declined almost 90% from its bubble era closing high in March 2000 to the ultimate trough in late 2002. The stock actually did not exceed its year 2000 high again until February of this year, so just almost 26 years later. However, while Cisco's rise, and to be fair, the subsequent collapse, were dramatic, the rally of that year to that year 2000 peak was far from smooth or a straight line higher. I think a lot of people kind of look back on this era with some sort of nostalgia, thinking that it was just a straight line higher, no corrections, no pullbacks. Absolutely not true. Look at the history of it. During the 4-year stretch from 1996 to the year 2000 highs, Cisco actually experienced 13 distinct corrections measuring more than 12% from closing high to closing low, and 2 corrections measuring 30% or more from closing high to closing low. Now here's a quick table to illustrate Cisco's absolute corrections back in the 96 to 99 period. Specifically, note that in early 1997, Cisco saw a 38.1% drop from a peak on January 21st, 1997 to a low on April 25th, 1997. And then in the summer of 98, Cisco plummeted 36.7% from a peak in late August to a low in early October 1998. On a relative strength basis to the S&P 500, Cisco also saw 8 episodes of underperforming the S&P 500 by 12% or more, including 4 distinct pullbacks of 15% or more over this period. Here's that table for you. In the early 1997 and summer-fall 1998 episodes, Cisco saw 38.7% and 29.3% relative drawdowns respectively. And in February-March 1996 and February to April 1999, Cisco saw relative drawdowns to the S&P 500 right around 15%. And Cisco experienced these nasty pullbacks in the context of a 1,700% gain from the end of 95 to late March 2000, compared to a gain of about 163% in the S&P 500 over the same period. In contrast, here's what we've seen on an absolute and relative basis for the Magnificent Seven since early 2023. Let's start with the absolute drawdowns. As you can see, the Magnificent Seven saw a near 30% drawdown from mid-December 2024 through early April 2025, and 2 corrections approaching 20%, starting in the summer of 2024 and the autumn of 2025. However, the absolute drawdowns in the MAGS ETF, they've been significantly smaller than what we saw from market leader Cisco back in the late 90s. Now, the relative drawdowns. On a relative basis, the Magnificent Seven underperformed the S&P 500 by almost 17% from December 17th, 2024 through April 21st, 2025. The most recent relative drawdown, starting on October 29th, as I said earlier, of last year, that's of similar magnitude. However, that's also far smaller than the relative 30% plus relative strength bloodbaths we saw in Cisco back in the late 90s. I suspect that what we're seeing in the Magnificent Seven right now is a classic shakeout, much like we saw in market leaders of the late 1990s, rather than the end of the big absolute and relative bull market in the Magnificent Seven that started back in 2022, 2023. Of course, that does not mean the relative weakness in the Magnificent Seven can't carry on for a while longer, or the relative strength drawdown be a lot deeper. We certainly saw it in Cisco back in the late 90s. After all, you've probably heard of the curse of the midterm election years here in the US. So take a look at this chart. This chart shows the average path of the S&P 500 and US midterm election years since 1950 as a blue line. This is based on the price only, no dividends, for the S&P 500. And I've set the beginning of this year value to 100. The orange line there is the performance of the S&P 500 so far this year on the same basis. Now, before I get into this in any depth, a word of warning. I believe many investors put way too much emphasis on seasonality and patterns in returns based on things like the US election cycle. I view these tendencies as, at best, a useful secondary or even really a tertiary indicator rather than a primary focus. And I also place little emphasis on the exact timing or magnitude of these normal seasonal moves. However, if I do look at the blue line here, that's the long-term composite, there is a clear tendency towards a flat to weak market through the third quarter of midterm election year. So from the beginning of the year through 3 quarters of the year, through the end of September. Really, it's more just a lot of chop, right, in markets than anything else. There's not necessarily a clear downtrend, but a lot of sort of up and down and volatility. Then there is a strong tendency for the market to rally in the final weeks of midterm years and into the following year. Generally, that starts just ahead of or after the elections, which are in early November. I think it's Tuesday, November 3rd, 2026 this year. There's some logic to that pattern, right? As midterm elections determine party control of Congress, so that can bring a lot of uncertainty. In most years, the party in control of the White House does lose seats in Congress in the midterms. However, looking at the political prediction markets this weekend, there seems to be even more uncertainty than in a normal midterm election year. I'm seeing on the prediction markets anyway, the probability of a Democrat sweep of the House and Senate at about 39%, the probability of a Republican sweep of the House and Senate at 22%, and the probability of a Democratic House and Republican Senate at 37%. So I don't want to dive into a detailed political discussion here, but that's a huge variation in outcomes with only around 4 months to go until Election Day. It does seem logical and in keeping with a normal pattern around midterm elections that we could see more chop in markets into this coming autumn. However, what's more important than the broader pattern in the S&P 500 is that in my experience, when you hear things like volatility or chop in markets, it's often a function of sector rotation and changes in market leaderships than it is a big market-wide sell-off. And that's exactly what we're seeing right now. While the erstwhile tech and growth leaders in the Mag 7 are experiencing a significant correction, as I said, 13+% just since the end of May, we're seeing stronger market breadth, more new 52-week highs on NYSE than we've seen in about 4 months, and strength in certain stocks and sectors that most investors won't notice if they're just sort of staring at the Magnificent Seven dominated S&P 500. One of those areas is healthcare. And I'll talk about that more in a minute. So let's move on with this. It's one of the hardest things, I think, for many traders and investors to do, even though it's historically one of the most profitable moves you can make. So I'm talking about buying strength and momentum. People hate to buy new highs, but that is actually a very profitable thing to do. One of the scans I like to do of markets, at least on a weekly basis, is to look for stocks making new 13-week, 26-week, and 52-week highs. Now, I find this screen particularly useful in markets like we're seeing right now, where there's a lot of significant underlying rotation and a change in market leadership underway. The chart I'm putting up on your screen here is very interesting in my view. So what I did is I started with a universe of about 1,000 stocks in the Russell 1000 index. Now, that's a large cap index that's broader than the S&P 500 because it has 1,000 stocks in it. And it includes a lot of the stocks that are actually in the S&P 500 mid-cap index and some in the S&P 600 small-cap index. Now, these are the stocks that rank above the Russell 2000 index. So the Russell 3000 index is actually the Russell 1000 and the Russell 2000. The Russell 1000 is the large caps, Russell 2000 is the small caps. So these would be larger in size than the Russell 2000, but the median size would be smaller than the S&P 500. So to create this chart, I downloaded weekly price data as far back as I could go, back to the 90s in many cases. Then I screened every one of these stocks to log instances where they made a new 13-week high. Now that's a 3-month new high. Then I looked at forward market returns from those 13-week absolute highs and compared these forward returns to the S&P 500 over the same holding period. Now that's what I mean by alpha. Alpha is simply the excess return of a stock over the S&P 500. So if the alpha over a say 13-week holding period is 2%, that means it beat the S&P 500 by 2%. If it's a negative number, it lagged the S&P 500. So look at the orange columns on this chart. On average, stocks making new 13-week absolute highs, 3-month absolute highs on the final trading day of a week go on to outperform the S&P 500 by 1.13% over the ensuing 13 weeks, 3 months, 2.81% over the ensuing 6 months, and 6.24% over the ensuing 1-year holding periods. So stocks making new highs go on to beat the market. Of course, a lot of investors confuse alpha and beta. Not just two different letters of the Greek alphabet, but if I buy a fast-moving stock like let's say, a name like NVIDIA, and the broader market ramps higher by 10%, that stock's likely to go up more than 10%, maybe 15 or 20%. That's because some stocks in the S&P 500 have betas more than one. They move faster than the market as a whole. That's what's meant by beta. Other stocks, think about a utility stock like NextEra Energy, the parent company of Florida Power and Light, which we use here down in the Sunshine State, or a consumer staple stocks like Coca-Cola or a healthcare stock. Now, a lot of these stocks and sectors have betas under one, so they tend to move slower than the S&P 500. If we look at it statistically over a multi-year period, if the S&P 500 is up 5%, these stocks might be up 3 or 4%. If the broader market runs up 10% and one of these low beta names is up 9% though, that might actually be a very solid gain in terms of a gain or a rally from a slow moving low beta stock. So in this chart, I also beta adjusted the alphas, right? So that's the blue columns. And these numbers are also really solid. Now they're a bit lower than the raw columns because a lot of the stocks that really crushed the S&P 500 in absolute terms after logging a new 13-week or 52-week high over the past 30 years, they were in high beta groups like tech. So when I beta adjust those alphas, they look less impressive. However, what I found really surprising and interesting is that a lot of the low beta groups like healthcare and consumer staples did particularly well on a beta adjusted basis after logging new 13-week highs. In most cases, they actually beat the market on a beta adjusted basis by a large margin. So they didn't go up as far as the market or only a little bit more than the market, but when you look at how low volatility these stocks are, they actually really performed great. So here's the same data, except instead of looking at 13-week highs, we're looking at new 52-week highs. Same basis as my first chart here, except that we're looking at forward returns on, again, the same group of stocks following 52-week highs. The mean alpha, excess return for the S&P 5, excess returns over the S&P 500 on both a beta adjusted and raw basis, they all look solid here. Humans are hardwired to want to buy things at a discounted price, right? That's why you see all these sales, for the 4th of July or back to school or Christmas, right? However, history shows that stocks making new 52-week highs that maybe don't look expensive or don't look cheap on a pure price basis, they go on to beat the broader market over 3-month, 6-month, and 12-month holding periods. So how about relative highs, right? So I generated relative strength indices for all these stocks, and I looked at situations against the S&P 500. I looked at situations where the Russell 1000 stocks made fresh 13, 26, and 52-week relative highs against the S&P 500. I then examined forward returns and alpha to the S&P 500. Take a look. I've done a lot of work and run a ton of historical data on market momentum in the past few months, so this is a huge topic. Way too big for me to run through it all in a single weekly deep dive video. I don't want to make these videos too long. So this week, let me just show you the data on new 52-week relative highs for Russell 1000 stocks. If you want me to dive into this topic at more length in a future video or in a written post for this service, just drop me a comment below. I'm opening up the comment section this week to both paid tier and free tier readers. Just trying that out. As you can see, stocks that break out on a relative basis measured against the S&P 500 throw up even more impressive alpha over holding periods from 3 to 12 months. Indeed, 12 months after logging a new 52-week relative high, these stocks go on to beat the S&P 500 by an additional 7.51%. The average raw total return for these stocks, not excess to the S&P 500, but just the average total return, well, it's a whopping 18.11%. So my point is that when the stocks everyone talks about all the time on financial television aren't working, it's time to start looking for what is working right now. There are a lot of hidden bull markets out there to be found for those willing to look beyond the headlines, and a lot of the stocks that are breaking out to, there are a lot of stocks breaking out to new absolute and relative highs right now. So take a look. I have created a momentum scoring model, which again, I can talk more about in an upcoming post or video if you like. But what it is, it's just a simple way for me to kind of help sort through these absolute and relative weekly price breakouts over periods of 13, 26, and 52 weeks. I've also beta adjusted relative weekly breakouts so that the relative breakout weightings aren't dominated just by those fast moving high beta sectors and stocks, every single week. In total, this weekend, right, I identified 94 names within the S&P 500 that scored well enough on that model to be worth a closer look on that basis. Now, that alone is interesting because just a week or two ago, when the broader market looked stronger on the surface, right, we were closer to all-time highs, there are actually fewer names and fewer groups popping up on this weekly scan. So here's the industry mix I found for the S&P 500. As you can see, healthcare, financials, and industrials account for more than half the list, while real estate and utilities, both groups covered extensively by my friend and colleague for almost 27 years now, hard to believe, Roger Conrad. Those groups are extremely well represented here, and he covers it better than anyone I know. I also ran the same momentum scoring model on a wider list of about 1,600 names. This list includes a lot more small and mid-cap stocks that have decent trading liquidity. Actually, I looked for a lot of names that also trade options, as well as some foreign stocks that I put in here that trade here in the US as ADRs, right? And these are names I follow, foreign names I follow. What's interesting here is that this is a similar list of sectors to what I found in my momentum screens on the S&P 500. A lot of small and mid-sized financials on this list, a lot of healthcare stocks, and a lot of industrials of all sizes. Also, a few technology and energy stocks in the mix, which is kind of interesting. So last week in the model portfolio in the paid tier of this service, we added a healthcare stock. It's off to a good start, though it's still a little below our buy under price. And late in 2025 and early this year, just as the Magnificent Seven were coming off their late October relative strength highs that I pointed out, we also added quite a bit of exposure to industrials and regional bank. So our tech exposure right now is outside the Magnificent Seven. So in my view, the key will be to beating the markets going forward will be to continue looking beyond the large cap tech names, as some of these other groups could be the biggest beneficiaries of the ongoing rotation we're seeing in markets. No telling how long that's going to last, but I wouldn't be surprised to see it continue into the autumn before we get that bigger, year-end rally into next year. Now, next week, I'll be out with a more comprehensive update on my thoughts on the energy sector as a written post on the site, but I am definitely seeing some interesting opportunities there as well. For now, suffice it to say that now that the immediate Strait of Hormuz reopening, sort of reopening anyway, sort of knee-jerk sell-off is fading. The knee-jerk sell-off is fading into the rearview mirror. I think oil prices are likely to generally head higher over the next 6 to 12 months. And as energy markets refocus from geopolitical headlines to the longer-term supply and demand imbalances, there will be a lot of opportunities. Now, this is basically the playbook I laid out in some posts here on this site right at the beginning of the conflict in early March. So there you have it. I hope you found this week's Sunday Deep Dive useful. If you enjoyed this week's video, please drop me a like or a comment. And as always, you can subscribe for free to make sure you receive these weekly videos and my other posts and updates. I do produce a lot of free content as well as the paid tier of the service. And you'll get an alert when they're released. If you'd like to give the paid tier of this service, Free Market Speculator, a try, that includes both the Free Market Speculator model portfolio I referenced earlier in this video and our popular Energy Bulletin Top 10 portfolio. If you want to give that all a try, I am offering 30-day free trials for a limited time via the link below. Thanks again for listening. I'll see you next week for another episode of my Sunday Deep Dive.